Okay. All right, so first I'm going to give an overview of the paper. So they do a great job of motivating the paper, thinking about firm uncertainty, right? So firms face a lot of uncertainty in many, many different markets. In insurance, clearly there's a lot of claims uncertainty. You can get very high, tail event. People would need major treatment. This is in health and property and casualty insurance that you can get very high. The risks are much more correlated, so you can get, a particular year with very, very high claims costs, right? Banking is another area. You get bank runs. Pharmaceuticals, tremendous uncertainty about the viability of drugs. Tech, obviously, there's a lot of uncertainty about whether particular investments will materialize. And clearly, for the most part, any R&D heavy industry is going to face considerable uncertainty. So what are the consequences of this uncertainty? Well, the most obvious is, well, it's going to, the fact that there's all this uncertainty means that firms are going to have to charge higher prices, or in the case of insurance, higher premiums, right? And they may have to also reduce the amount of coverage that they're offering, right? Have higher deductibles, higher co-insurance, and the like. Okay? Insolvency is also a big issue for these firms, particularly insurers, right? If there's a, especially in Florida where I now live, we get hurricanes, and a big hurricane comes in and it wipes out a lot of these insurance companies. To the extent that there has to now be we have a public insurer called Citizens, which has to insure many of the properties in Florida. And then finally, firms may just decide they're not going to participate, right? So that's why we have a public insurer in Florida, because the private market just can't handle all the risks that are occurring in the market. Okay. All right, so there are many government interventions that the government can undertake to reduce this uncertainty. So this paper talks about reinsurance, right? So this is insurance for insurers, right? So they offload some of their risk onto a reinsurer. That can be other private firms, right? So there's private reinsurance, and there's also public reinsurance. The government can also provide insurance. The similar concepts, deposit insurance, right? So you're, I guess, up to $250,000, your deposits are insured in a bank, right? We see this in other industries too: loan guarantees with mortgages, student loans, pensions, and then there are other policies in the in insurance markets that are used to try to reduce uncertainty. So one of the big ones is risk adjustment, and then there's also been use of risk corridors. We've seen this in Medicare and in the ACA exchanges. All right, so the more theoretical motivation here is that in the IO literature, we always assume firms are expected profit maximizers, right? We start from that assumption. So we're not really thinking about firms being risk averse, right? We assume that they're risk neutral, right? So this paper is going to advance is going to contribute by thinking about firms having some level of risk aversion and modeling uncertainty as part of their objective, okay? So to deal with this uncertainty, insurers are going to buy reinsurance, right? Just as a bank would hold capital reserves in case of a major run, right? Okay, so in this paper, what they're going to do is they're going to allow firms to consider uncertainty and model both uncertainty and the purchase of reinsurance. Okay, so this setting occurs in the study occurs in the ACA exchanges. Okay, so they're going to look at public reinsurance. There were two ACA reinsurance programs. So one was a transitional federal program that was in place during the first 3 years of the exchanges from 2014 to 2016. And then they're going to look at state programs that reinstated reinsurance later, starting in 2018. Okay, so they've got both time and cross-section variation in their data, right? In the ACA, there's a lot of rich data. They use an all-payer claims database to look at the dynamics in the ACA exchanges. So this is a really good setting to look at, setting that I've used in much of my work as well. And then, okay, so Public reinsurance is going to serve two purposes in this market. So first, it provides a cost subsidy, right? So you can think of premium subsidies as subsidies on the demand side. There's subsidies to consumers, whereas reinsurance is almost a cost subsidy. It's a subsidy to the insurers, okay? But it's going to have another purpose too. It's also going to serve as having, it's also going to offer risk protection to the insurers, right? So if they have somebody who needs, like, say, a heart transplant and it costs, $500,000, they're going to get some money back from the reinsurer. Right? So it has a dual purpose in this setting. Okay. All right. So let me just briefly talk about their findings, and then we'll probe further later as I discuss their results. They find in their data that in the all-payer claims database from Colorado, that the medical spending distribution has a very long right tail, right? So there's substantial uncertainty that the insurers are going to have to deal with. Most of the health insurers in the ACA are purchasing some level of private insurance, but the ones that are purchasing the most are the small regional insurers, right? They don't have as much diversification to handle, a huge risk, a large risk, so they need to purchase reinsurance to reduce that uncertainty. Okay, they run several event studies to assess the effect of public reinsurance, okay? So they find that the public reinsurance reduces premiums by 15%, so that's pretty consequential, right? And there's almost a multiplier effect with this reinsurance. So every dollar the government's spending on reinsurance, they're finding that premiums are going down by more than $1. Okay, so that's got to mean that there's something else going on just besides the cost subsidy, right? So there's also the cost of the financial risk that's there, right? So that's offering some reduction that's more than what the government is spending. Okay? And then they're finding that there's some crowd out, right? So as the government is providing public reinsurance to these insurers, the insurers are substituting away from private reinsurance, right? So there's some crowd out going on as well. I don't know why I keep going to the computer. Then they build a structural model of demand and supply, and they come up with a number of very interesting results. So they find that as I was just saying, the regional insurers have higher costs, and that's because they have a greater cost of holding the risk, right? They're exposed to more financial volatility, and then the financial risk for these insurers is as important as market power and high premiums for the small regional insurers, right? So it's playing a big role in their business model. Okay. All right. So then they run several simulations using their structural model. And they find that there's three mechanisms in which public reinsurance is affecting the market, right? So first, as we've talked about before, it's providing a direct subsidy to the insurers, right? It's also improving it's helping them, especially the small regional insurers, helping them reduce their uncertainty, right? And then finally, by bolstering these smaller insurers, it's enhancing competition because it's making these smaller insurers more viable and enabling them to compete with the larger insurers. Okay, so those are the mechanisms under which the public reinsurance is affecting the market. And then one of the last exercises they do, which I think is critically important, especially that we know now the government is shut down because of the Obamacare subsidies, right? So this is a critical policy. And what they do in the last part of the paper is compare public reinsurance to premium subsidies, right? So if you think of public reinsurance as a supply side subsidy, this is a nice comparison, right? You've got a supply side subsidy versus demand side subsidy, right? So what they argue is that reinsurance is more efficient, right? So it's not only providing a cost side subsidy, but it's also reducing risk, right? It's going to have two effects. So it's going to shift down the marginal cost curve, right? So that's going to bring down premiums, right? But because it's also mitigating adverse selection, it's going to flatten out the marginal cost curve, right? And as a consequence, the insurers have less incentive to keep premiums low, right? So you can think of, as you're flattening out the cost curve, mitigating adverse, marginal cost curve, mitigating adverse selection, insurers have less incentive now to keep this because they're not as exposed to low risk dropping out of the market, right? So if you have a very steep marginal cost curve, then the low risk will leave if the premiums go up by a little bit. But if it's sort of flat, you're not so worried about the low risk leaving, right? So that's going to allow insurers to increase their markups, right? But they find that the first effect is more dominant, right? So the provision of risk protection is much greater than the increase in markups. Okay, let's see. Checking with the time. I'm good, okay. All right, so they do a lot of work on a theoretical model, which I'm not going to get into too much, but I did want to just highlight here the overall objective. So what's different here and where they're contributing is they've got your typical premium revenue and expected claims cost, right? Those would be typical terms you'd see in objective. But what they're adding is this cost of the financial risk, right? And they're going to think about how to specify this. This is an abstract function here, this loss function. But that's where they're adding to the literature, right? They're adding this cost of financial risk. Okay. Okay. So I don't know what level of familiarity everyone has with the AC exchanges. I assume most of you are somewhat familiar, so I won't spend too much time here. So the AC exchanges provide coverage to people who are buying insurance directly, right? Most of you probably get it through your employer. I get it through FSU, and I'm sure a lot of you here get it through Michigan. So eligible consumers can get premium subsidy to go buy coverage from a private insurer. Okay? And there are a lot of regulations in the AC exchanges. We call this managed competition. So one of the big ones is there's what we call modified community rating. So there are only a few things they're allowed to rate on: age, tobacco status, and where you live. And then even those are regulated as well. There's also guaranteed issue, which means you can't deny people coverage who want to buy coverage. And there are a lot of essential health benefits that have to be provided. So there are a lot of regulations. This is just scratching the surface on all the different regulations that are present in the AC exchanges. Okay, so what makes this a nice setting is that there's a lot of uncertainty, right? So consumers churn in and out of these markets, right? They're getting jobs, they move to group insurance, they lose their jobs, they enter the AC exchanges, and they go back and forth, right? It's also a pretty small market compared to the group market, right? So the group market is 150 million people. Here we're talking at most about 25 million people, right? So you can get, this is also not a a lot of these are not workers, right? So you can have large or unpredictable claims costs in this market. They're not necessarily the healthiest people, right? And then, as you can see with the current government shutdown and previous government shutdowns, there's a lot of policy uncertainty, right? So, policies are changing frequently, and that's something that the insurers have to be prepared for, right? Okay. The other, and this gets to the heart of what they're talking about, are what I call the three R's. So reinsurance is the focus of this paper. I'm going to talk more about that in a second, but I do want to highlight risk adjustment and risk corridors. So risk adjustment is a permanent policy, and in the AC exchanges, it works a little differently than Medicare. In the AC exchanges, it's a zero-sum transfer program. So insurers that draw a lot of low risks pay the insurers that draw a lot of high risks, right? And the determination of those transfers borrows a lot from Medicare Advantage, but it's a little bit different because Medicare Advantage, it's used to determine the payments the government makes to the insurers, whereas in the AC exchanges, it's a transfer program. That's still in place. Risk corridors are no longer in place. This was a brilliant idea that insurers that made a lot of money would then, share some of that with the insurers that didn't do so well, and it would be self-funding. It was not self-funding. So a lot of the insurers lost money, and you had Marco Rubio saying it was a bailout for the insurers, and that program was a total disaster. So that's sort of off the table now in the AC exchanges. But risk adjustment's still there, and reinsurance has come back in a lot of states. Okay, so the private reinsurance market is not really as big a deal in health insurance as in property and casualty, but it's still there. It covers about 4% of premiums in this market. Potentially, it's crowded out by public reinsurance, right? Maybe it would be a bit greater if we didn't have public reinsurance. And it's a very concentrated market. Okay, so let me talk about the public reinsurance programs. So when the ACA was first initiated, the framers were worried that insurers would not want to participate because there's potential for very high claims cost, and you wouldn't have a lot of competition, right? So they had a sort of a phasing out program where the goal was to collect $10 billion for reinsurance in 2014, $6 billion in 2015, and $4 billion in 2016. And the funding came from, I should use past tense, right? The funding came from the health insurance companies, not just in the AC exchanges, but throughout the group market, non-group market, and self-insured group plans, right? So they all had to pay for this reinsurance program. So to get to that 10 billion, 6 billion, 4 billion, there was an annual per enrollee fee, which was $63 in 2014, $44 in 2015, and $27 in 2016. Okay? So the terms of the program were set up by Department of Health and Human Services. So they specified an attachment point at which the reinsurance would kick in. Then there was a co-insurance where they paid a certain percentage up until a reinsurance cap. And above the cap, the insurer was then responsible for all the fees above that, or all the claims cost above that. So they were a little bit too cautious in 2014, so there was actually a surplus of reinsurance funds for 2015, 2016. So that had some effect on the reduction in premiums that you would see from reinsurance. Okay, so that program went away in 2016, and then in 2018, a lot of the states started reinstating reinsurance under the ACA Section 1332 waiver program. So the main mechanism under which this was funded, or is funded, because it's now in effect, was, so let me see how I can explain this briefly. So under the ACA, the premiums determine the subsidies, right? So when premiums go up, the subsidies go up so that consumers are largely shielded from the premium increases. So if you have reinsurance, which is going to have a big reduction, lead to a big reduction in premiums, then the subsidies are also going to come down, right? So the government said, okay, well, if you set up this reinsurance program and we don't have to make as much premium subsidies, then we'll essentially give this money to you for your reinsurance program, right? So they were trading the premium subsidies for the reinsurance, okay? There are also that funds most of it. There's also some fees that the states will collect from the insurers. That's another funding mechanism. Okay, so in Colorado, which is the main part of this study, where the data for the study comes, there was the reinsurance policy had an attachment point of 30,000, and they wouldn't pay above 40,000, right? So that was a reinsurance cap, and then there's I think that should be 400,000, right? That's not much of a range between 30 and 40, right? So the attachment point was 30,000 and the cap was 400,000, and then there were 3 tiers of counties where the co-insurance varied from 40% to 80%. Okay, and this map shows you which states have a reinsurance policy. So the ones in dark blue have a reinsurance policy. There are 18 states with reinsurance policies currently. The ones in orange tried to adopt one and then abandoned their efforts. And we had Louisiana in light blue, and I looked them up today, and they also abandoned their efforts. So there are 18 states with reinsurance now. Okay, so they get their data from, they have insurer level data and consumer level data. So the data come from CMS and NAIC. And the consumer level data, this is the real rich data that they have. They get data from Connect for Colorado. I remember talking to Paul back in May, and I said, how come they gave the data to you? I asked them for data, they wouldn't give it to me. So apparently they were more persuasive than I was in trying to get data. Okay, and then they also have the all-payer claims data from Colorado. Okay. All right, so here's some summaries. Okay, so here are some summary statistics from the data. So this compares insurers that have a private reinsurance policy to insurers that don't have a reinsurance policy. So you can see that they're largely smaller, right? So this is number of members, and you can see that the ones that don't have a reinsurance policy are bigger than the ones that don't. And let's see, what else I was going to say about this? They're also a little more profitable, right? So the ones that don't have reinsurance have a higher RBC ratio than those that do. Okay. All right, so then they run a series of really interesting event studies. So you can see that the premiums fall with the introduction of reinsurance. And then they do it in Colorado by the tiers, and the one that falls the most is the one with the highest the highest coverage. The tier 3. Okay, and then they also find that the introduction of public reinsurance leads to a reduction in private reinsurance. Okay. And then this regression looks at are there larger responses from more financially constrained insurers, and yes, that's what they find, right? So this interaction term here is greater than this one here, right? So the insurers with the lower RBC ratio, the insurers with the lower RBC ratio are having a much larger premium reduction than those that have a higher RBC ratio. Okay. All right, so the model is a fairly standard demand side model. I think as I was talking with the authors that there's some modeling choices they make. So they're grouping plans by metal tier. I think that's because of what you see in the all-payer claims data. So that makes sense. There's variation in premiums by age, bid, and markets. There's some averaging going on, and I think there was no income data in the all-payer claims data, so that limits the ability to calculate subsidies. So that's why you don't see the subsidies varying by I, right? There's no I subscript on the subsidy. Otherwise, this is a fairly standard setup. Okay, on the supply side, the specification of the firm's profit includes, as we saw before, the premium revenue, the claims cost, reinsurance, and this variance term, this loss function, right? The one quibble I have here, and this is probably my main criticism of the paper, is there's no risk adjustment here, right? So risk adjustment is certainly going to affect the magnitude of the effects that you see with reinsurance, right? Because risk adjustment is adjusting for the average risk that of the pool that the insurer gets, right? And reinsurance is kind of cleaning up you can think of reinsurance as kind of cleaning up the totally unexpected, much higher risks, right? But if you're ignoring risk adjustment, then reinsurance, the effect of reinsurance is going to seem much greater, right? And risk adjustment is not small, right? I think the transfers tend to be about 10% of the total of the premiums, right? So it is something. I realize it's, I mean, I had a lot more hair before I tried to code up the ACA risk adjustment formula. I realize it's really hard. There might be some ways to make it a little simpler. We could talk about that offline, but I think it's something that does need to be part of the model. Risk corridors, I think you could leave that out. I think I've only had one or two referees ever say you need to have risk corridors in there. It got rejected anyway, so I wasn't going to say anything. Okay. Okay, so I'll skip through this because this is pretty standard. It's a BLP type estimation. And the main source of identification is coming from the age rating regulation. If you had the individual mandate in there, you could think about using that as well. There's some exogenous variation from the subsidies, but I guess your data may not allow that. The supply side parameters, I might skip through this given our time constraints, but they're using GMM on the supply side, and the first order conditions are with respect to both the premiums and how much private insurance the insurer is buying. Okay, so here's some of their results, and they find that I'm pressing the wrong thing. They find that the smaller insurers have a higher risk preference, right? So they need to buy as their equilibrium purchases of reinsurance are going to be greater than the larger insurers, right? So that's consistent with what we would think. Okay, and then here are their main results. What's the effect of public reinsurance? You can see that there's a big reduction in premiums. This the wrong way. There's also less spending on private reinsurance. That's the private reinsurance that's only about a third of what it was, right? So that's a huge reduction. You can see there's also a big gain in consumer surplus. My only comment here was, usually with the premium subsidies, the consumer surplus gains go to the government, right? So that would be as a result of the price-linked subsidies. Okay, so let me, in the interest of time, let me just get to the comments. I think I've hit most of them. But I think this is a great paper. You have great data. I'm very jealous of the all-payer claims data. That's fantastic. I really like the theoretical model. The reduced form results are really good and really give you some good insight. The structural model is very well done. I really like all the counterfactuals. And by modeling risk, financial risk, and the firm objective, you're really advancing the IO literature. So I think that was all great. Just a few points to consider. I just want to emphasize that the public reinsurance program is not free, right? So the insurers are typically either paying a fee or they're sort of tacitly agreeing to reduce the premiums, right? So I just wanted to point that out. I think the way you're modeling premium subsidies is a little off. I'm not sure if there's a better way to do it if you don't want to get into modeling price-linked subsidies, because that's very hard to model. But that's leading to some results, I think, that we saw with the consumer surplus that probably aren't plausible. I think the biggest issue, and this is something you may see with referees, not modeling risk adjustment. I think that's probably Unless you get hopefully you get a referee that doesn't know too much about the AC. That's what I always hope, but it never works out that way. So, and then these other comments are minor, but I think the risk adjustment was the main one that I wanted to highlight. So, all right, I'll stop there since I'm out of time, and I'll turn it over. Oh, you're gonna use your laptop.
No, I'm just taking notes. Should we bring back this?
Oh, I should have left them. I'm sorry.
All right. Thank you first to Alan for discussing our paper and offering these excellent comments. Let me quickly respond and I'll take questions. So I think the biggest issue, I go from the most important thing, is the risk adjustment policy. That's a great point. So we haven't included that in the paper, but I do wanted to point out the difference between risk adjustment and reinsurance. So risk adjustment policy is ex ante because it's based on the individual's expected cost according to a government formula. Reinsurance is a transfer ex post after the individual's claims has happened. If you are over a threshold, then the government will reimburse you, which kind of changes the tail end of the cost distribution. So the key insight of this paper is that not only the expected cost matter, but also the cost dispersion matters, which is the standard deviation of the cost, or in other words, like risk dispersion, things like that, which reinsurance policy aims to correct for. So how reinsurance is reimbursing insurers also changes the expected cost part, but what our model really wanted to capture is this loss function or the standard deviation part of the medical claims cost, which are going to factor into insurance prices. So I feel like including risk adjustment will change the magnitudes of the estimates a bit, but I won't expect it to affect the key forces that our model tries to capture, or this key insights or new insights that we want to bring upon, that financial risk or this cost dispersion really matters to insurance company, and that's where policymakers want to focus their attention. Other things about the institutional details. So we acknowledge that we haven't had all these like individual mandates, things like that in the main specification, but we did discuss how that would affect our estimates in the appendix. We want to keep the main model kind of concise and small just for ease of like reading, but we are very happy to follow up and see what else we need to do to make the exercise more reflecting the institutional details without kind of throwing a bunch of details into the paper writing. I think that's my responses, and I'm happy to take questions.
A couple of related questions that might be total nonsense because I don't really understand finance. Is there any way that we can think about these numbers in terms of some kind of risk aversion parameter? And if so, do you have a sense of what that would look like?
Yes. So in the paper, in the theoretical model section, we did provide a micro foundation of where this is coming from, and that loss function can exactly be interpreted as the insurance risk aversion if you're willing to put some expected utility assumption on insurance profits. So that's all discussed in the theoretical model part in the paper and appendix.
I guess then if it's a person, like, would we think these numbers are big? Would we think they're small? And relatedly, should we think of this as risk aversion? Do you have a sense of this as risk aversion of the firm or risk aversion of the managers?
That's-
This line segment, business might not be big from the firm's perspective. They're big in the employer market.
That's a great question. So I don't have a sense of how large that compares to individuals' demand for insurance of like firms' demand for reinsurance. We can definitely check that. I think what that parameter captures can be interpreted both as kind of firms operating as a whole or its managers trying to maintain, for example, a positive cash flow or maintain a good corporate performance. So that interpretation is kind of free. But that's a good point that we can compare to individual demand.
So when I think about the purpose of insurance, it is to smooth out risk. And so at the beginning, you have this stylized model where you have a loss function of the standard error of the entire group. And if the risks are IID, you would think that as you get more and more people into your plan, this is not reinsurance, just insurance plan, the risk would go down. And so I guess for reinsurance, then I don't understand why there would be the more than one pass through. Could you explain more of why you think that this more than one pass through happens? Because it doesn't seem like there's any risk of these insurance companies, something would have to go wrong over a wide swath of people for something, these risks would have to be correlated in some way.
That's a great question. So I agree with you that both correlated risk and independent risk can be problematic depending on the sample size. So what we do in the paper, in the descriptive section, like right after data, is we take the claims cost distribution from Colorado all-pair claims data. We simulate how many individuals you will need to make that tail risk kind of go away when law of large numbers starts to bite. So what that simulation tells us is that you need at least 10 to the power of 5 times of number of individual in the plan, which is like 100,000. But for a lot of the ACA plans, their number of enrollees is below that threshold. So there, when the government is thinking about regulating this insurance market, of course we want competition there, but not more number of players, meaning that on average, each is getting a smaller number of enrollees, making the risk pool very fragile. And that is another key insight of this paper, that to maintain effective competition on the market, you really need to pay attention to these cost frictions or supply side frictions. There's a returns to scale in insurance market, and just injecting like insurance company into the market will not work exactly because of this financial risk or risk aversion that insurance company have. But our theoretical model does allow for the correlated risk. So it's very, I would say, general-ish, but just specific to our setting, we don't think there's a big systematic risk there. So in the empirical model part, we did take out the correlated risk and just do IID individual risk.
Sorry if I missed this, but are there insurers that operate both on the exchanges and in the commercial market? And how are you modeling or including them or not including them?
Yes, so there are insurers that only operate on the exchange market and insurers operate on both markets. So what is cool is that we observe the private reinsurance purchasing records for all those companies. We see that those regional companies, they tend to purchase more of the private reinsurance contract. Whereas those national company or company who operate on multiple market segment is kind of a hedging for them across segment. So they purchase less of the private reinsurance contract.
But the private you can't get private reinsurance for the ACA exchanges. This is like private reinsurance for your private commercial
You can, as a company who operate on the ACA exchanges, you could purchase a private reinsurance contract specifically for yourself. So you have access to them, and what we find is that for companies that only operate there, tend to be like those small regional companies, they purchase more of the private reinsurance. Whereas like, say, national companies like United, private reinsurance doesn't matter for them too much, and they purchase very less of those private reinsurance contracts. This is another kind of a proof of concept that financial risk is really binding in this insurance market.
Thank you very much. Great paper.